Yes. This is what I looked like before I grew a beard. Okay. So let me say what I'm going to try to do, and a little bit the background of this. So in 2022, after our JEL paper with Francisco Gomez and Tarun Ramadurai on household finance came out, and in which we had exactly 499 references. We couldn't find the 500th paper. Anyway, and there was no mention. There is, if you do a word search on climate or environment in that paper, you won't find any instances. I got an invitation from a professor of medicine from the US to participate in an interdisciplinary school for the environment and climate, and to say what my area of research, household finance, had to say about that. So I took that as a challenge. That was December, I had to give it to December 22. And I looked and looked, and I found very few papers before 22, but a number of working papers that were coming out in 2022. And I did it because the best way to teach, to learn something is to teach it. So I did it, and I learned quite a bit. And then somebody else heard about that, well, the editor of this volume, and she said, why don't you write it up for this volume, deadline December 31st, 24. And I said, sure, I mean, I just write up some slides, it won't be any problem. And then on the 1st of December, I started looking at my notes, and I thought, okay, let me check if anything else has been written. And it turns out tons have been written, you know, in 22, 23, 24, so tons of things have been written. And suddenly, you know, it came to, you know, it destroyed my Christmas, my New Year. I mean, that's another story. But what I want to do today is to try to talk about some of the things I found out, and to sort of think like a household finance researcher, you know, with the different boxes that we have in household finance research, and to try to open, you know, different boxes and find, you know, potential content, you know, climate, environmental content that we can fill in, that future household finance research can also fill in, because I think it's quite exciting. So this slide, you know, has a number, you know, of these things, a summary, an overview, if you like. You know, let's think, you know, normally we think of a household in a life cycle model, trying to maximize expected lifetime utility of consumption. And it has assets, and it has debts, it has some portfolio choice, and it has access to different factors. So where, you know, does climate and where do climate and the environment come in? First of all, you know, there are two important things. There is physical risk, the risk of physical destruction. There is also transition risk, which has to do, you know, with adoption or imposition of regulations and of costs on people and of particular behaviors that they have to undertake. So one, you know, channel is to look at consumption effects of climate change and environmental disasters. These could be supply disruptions. There could be also, you know, our research finds background risks and recently has highlighted expenditure shocks. So there can be expenditure shocks out of climate and environmental change. Things that, you know, it could be to replace damaged houses or, you know, cars or whatever else, but also expenditure shocks to undertake particular measures, protective measures. Then you can have employment and income shocks from plant closures, relocation, and search. Then, we can go to wealth shocks, and we are interested in real assets. Okay, there are houses, and there's other real estate that can be destroyed. But there are also financial assets, stocks, bonds, green stocks, green bonds. What is going on there? The less obvious liabilities. We care very much about borrowing constraints, the availability of loans, the terms on which banks are willing to offer loans. Banks themselves may change the terms that they offer and the ease with which they offer these loans when faced with climate change. An important thing, to realize is, the first thing that we think about is, a physical disaster takes place, and then, it's obvious what is happening. But there are actually different levels, layers of these risks. So you don't need a physical disaster to occur and to affect your property for you to be subject to these shocks. So there can be changes in environmental regulations, this transition risk that I mentioned. There may be changes in beliefs about climate change. So what others are thinking, what market participants are thinking about the likelihood of climate change and an environmental disaster, and this can affect the price of your assets and the perceptions that they have. There may be even changes in attention to climate change, and I will give you examples that affect stock markets and affect also the prices of housing, etc. Now, something that we pay a little bit less attention to in household finance, but we need to pay more attention to, is insurance. And there has been some excellent work on insurance, but rather limited still. Insurance could mitigate some of these effects, but these effects tend to, these risks tend to be quite concentrated and quite big, and, in particular locations. And then it's a question, who is going to insure you? Is it going to be the state? Is it going to be the private sector? And I'm going to tell you a little bit about this, and that, it won't surprise you to find that it's mostly the state if it is willing to do it, and the private sector is not particularly excited or interested in entering some of these insurance markets. And then, in recent years, we care a lot with our data about wealth inequality and changes in wealth inequality. And climate and environmental changes can be a very important potential source of effects on wealth inequality. When the rich are going to the safer places, and the poor, have to live in the lower territories and regions that suffer, more climate risk and have more affordable housing. And of course, they can have financial assets, that are very different, and they can face changes in their potential to borrow. Now, household finance also looks at mediating factors, at the environment within which households operate. So peers, are there peer effects in dealing with climate change? Can you learn from your peers how to address some of these issues from their experiences? Then we have 20 years of research on financial literacy. How about green financial literacy, which is about the products, it's about the behaviors, mitigation behaviors, it's about, habits that would be good to adopt, but also knowledge of the different products that are available there. How about green financial advice? We have rather depressing and disappointing results on the effectiveness of financial advice, or the positive role, at least on average, of financial advice. And, you know, one of the factors is how much do financial advisors know? Well, how much do financial advisors know about the climate and about how to deal with these issues and climate change? And of course, you know, what incentives might they have, you know, financial misconduct, and, you know, are they being matched to the people that need them most, or not? You know, the general financial advice research finds that financial advisors typically are matched with the wealthier, the older, the most experienced people, and not with the young and inexperienced who need the most. And I suspect similar things could be found also for green financial advice. And finally, for the private sector, you know, the financial product design, you know, are there, how about green financial products? Could they be designed in a way that people understand them and might be willing to invest in them and to benefit from them? So that's a sort of overview. Let me give you some examples, and, you know, you see references there. So there is work that shows that, you know, natural disasters can lower employment incomes, have had significant effects on house prices. So, you know, Hurricane Sandy in New York City, you know, has been documented as having a 17 to 20% of, you know, permanent relative price decline of damaged properties. So that there would be an effect on damaged properties is not surprising. You know, the size is surprising, but here is a surprise. It's not a linear relationship. It's not that the price of the house, the damaged house, goes down. Then, you know, they find that after 5 years it goes up, and, you know, maybe it is higher. And where is this coming from? Well, it may be coming from insurance money and rebuilding these houses and really equipping them better later on. But there is also considerable exit of insurance companies from those areas, so the insurance possibilities diminish. On the positive side, measures to mitigate climate risk, like, for example, a seawall that was built in Venice. These tend to have tangible effects, you know, raising house prices in the area. But, you know, these are, you know, the actual immediate effects, but then you have changes in beliefs and perceptions about climate change. And do these affect asset prices? And there's this study that non-damaged properties in the flood zones converge, the effects on non-damaged properties, the downward effect on house prices in non-damaged areas converge after a few years to the effect on the damaged properties, because the perception of the likelihood of disaster has changed. And even an increase in the share of believers in climate change. You know, how many other people in the area believe in climate change is associated with, you know, a 1 standard deviation increase with a 7% decrease in house prices for homes projected to be inundated. And then there is another layer, which is attention to climate change issues. And there are two interesting data sets that are generally available there. There's one at Yale with Stefano Giglio and Johannes Ströbel. There is a climate attention index where they are looking at the words in the advertisements in the listings of for sale properties, and they track the frequency of words like hurricanes, FEMA, floodplain, flood risk, etc. And then they try to relate this to outcomes. And, you know, one of the findings is that a doubling in the climate attention index is associated with a relative 2.4% decline in the transactions prices of properties in the flood zone. So these are changes in attention. And there's another index that I'll talk about a bit later. Then you go to financial asset prices. And, you know, there is this big debate and discussion about, is there a greenium? I mean, is there a reduction in expected returns that and yields that have to be offered, you know, by stocks and by bonds if they are associated with green projects or with companies, you know, in the case of stocks, firms aiming at reducing emissions and energy use, more responsible, you know, ESG type companies. Now, one thing that this literature is stressing is that there is a lot of heterogeneity among retail investors' views, even in the same country. And actually, you know, this paper by Aaron Dine and Johannes Beutel and others that in 2025 that actually gets presented in the academic conference looks at German households and finds considerable heterogeneity even there. 34% of German households own some green assets, and these comprise 11% of aggregate household financial wealth. But there seems to be quite a bit of interest in more, you know, green assets and green deposits and, you know, possibilities for participation in such green assets going forward that could be exploited by the industry. And then you have the bond market, and you look at green bonds, and there is literature on whether there is a greenium there or not. There is, you know, climate finance literature that has looked a lot, you know, at these issues. But, you know, there is a big problem. You know, we normally talk about awareness issues in household finance. Do people know about, you know, the different financial products that are available? But, you know, when you go to green financial products, you hit an extra layer, because actually objectively classifying bonds as green bonds or stocks as green stocks is not immediately obvious, you know, how you do this, because the reporting is not necessarily at the desired levels. Then there is some starting literature. Actually, this paper, Ceccarelli and Ramelli, was presented in a household finance session in the Paris symposium last December. So having high expectations of the degree and pace of the energy transition leads to expectations of a higher premium and participation in green funds. So there is a link between, you know, climate expectations and actual financial actions, or at least, you know, the start of providing evidence to that effect. And here is, you know, the attention index applied to financial assets. So this is another index by Kostovetsky and co-authors, and they look at a newspaper-based measure of regional variation in attention. And they use exogenous changes to these newspapers, like a change in a newspaper ownership or changes in climate attention okay. Yeah, this is very round, but you know what you showed me. Okay, in a different area that's socially connected to that area, etc. And even abnormally warm weather draws attention to climate and affects stock market sales of carbon-intensive firms. So you get lots and lots of these of these effects. So I'm at negative minutes, so let me just say one word about a couple of other things. So the one is, so I'm the Michael Greenstone, but yeah. On insurance, public insurance does the most. In countries where there is no public insurance of climate risk, it is discretionary spending by governments following a disaster. So you get, you know, the disaster, and then you get public protests, and then governments decide to do something, but they're not prepared for it, etc. And you know, we will go into the panel also, and maybe we discuss there as well what incentives private insurers face, and whether they actually are actually willing to enter these markets. But the literature suggests that they are not. Also because they don't know how to price these insurance contracts. There are effects on banks, the credit risk, non-repayment by people affected by environmental disasters or climate change, and of course market risk, about the prices of financial assets that banks hold. And there is very sparse literature on how banks adjust their terms to climate change. So there is more room for that. There is of course quite a bit, some starting literature on the effect on how natural disasters affect individuals and their ability to repay their loans. Or their tendency to even pay off early and leave and go somewhere else. There are effects on the distribution of wealth. The rich displace the poor in pursuit of high ground. That's a very telling sentence from one of the papers, that the rich are climbing up the hill where the flood risk is lower, and then the poor are left next to the sea level, where the housing becomes affordable. But what are the longer term implications of this? There is evidence of peer effects. Again, these Facebook type studies, finding effects of experiences of people friends in remote areas, how do they influence their distant friends in other areas, in buying or selling assets, but also insurance. And of course, life experiences can also be relevant there. A positive thing, the changing nature of investors. So retail investors YOLO for environmental and social causes. So what's the good news? The good news is that the millennials and the Gen Zers are not like us. They are getting money now, and they care much more about the environment than we ever did. And they are activists and collectivists. And they really communicate, and they are willing to intervene and to push firms into taking more positive, environmentally positive, ESG positive attitudes. And finally, and that's the final thing, we should be thinking about green financial literacy, financial advice, peer advice, simpler financial products. I haven't seen anything much in those areas, but I think this is a very natural extension for this. And let me just put up as a commercial, it's still going on. This is what got me started in all of this. It's a free program for the admitted students, and the instructors don't get paid anything. So I think it's okay to show this commercial. So if you have students that might be interested in this, get them to go. Thank you very much. We'll have now the break.